What's up, guys? It's your boy, Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Zynga, ticker symbol ZNGA, trading for $9.58 as of June 27, 2020, equating to a market cap of $9.1 billion and a PE or price per earnings ratio of, holy Zynga, with a whopping price per earnings of 150. So, what's the move? Should we go all in on Zynga or continue to store our cash in farm bucks? This is your quick stock analysis. Brace y'all self, I'm about to flex on y'all. We've got a whopping 1 share of Zynga representing a smooth $9.50 profit. So, for transparency's sake, I was actually gifted a free share of Zynga from Robinhood. Which, entertain me for a second. Let me take y'all back. Imagine buying or being gifted your first share. Your friend was hyping up this brokerage app named Robinhood. Or after seeing a Facebook or Instagram ad for Acorn, and how if you could save a mere $2 a day, you'd be a billionaire Bobby in as little as 125 years. So of course, you download the brokerage and you are gifted 1 free share of Plug Power or Snapchat, or in many people's cases, Zynga. For a lot of people, this is the first company that they've ever owned a piece of. So naturally, what do? They look it up, and to their surprise, they are now the proud owner of the creators behind masterpieces like Farmville. Yes, granted, many people will immediately sell it. However, it creates incredible brand interest to the best customers who are millions of noobs looking to start their investing journey. For real, these penny stocks, and by that I mean companies with a share price of $1 to $5, should be paying Robinhood to advertise their business. Which, after this long-winded intro, leads me into my first point. Sometimes, hype surrounding a company is enough to drive share price up, which Zynga is definitely not lacking any hype. When we check Robinhood's 100 most popular companies, I was kinda surprised to see Zynga in the top 30 most popular companies. And here on YouTube, we can see Zynga is definitely getting some love. But don't get it wrong, it's not necessarily unwarranted hype. After all, the company is a beast. When we look at the company, we see the general public owns 13% of Zynga. And just like every other company, the Buddy Fight Vanguard group is a primary shareholder with nearly a 9% stake in Zynga. The second largest stockholder is a bit more interesting. Artisan Partnership with a 6.14% stake, equating to over 58 million shares or over $536 million, which for an asset manager the size of Artisan is actually kind of staggering. To quickly summarize the company's recent earnings call, Zynga acquired Peak Games for $1.8 billion, which is expected to bring Zynga's 2020 annual sales up to $2 billion. Which, if I'm being honest, I had never heard of up until making this video. But if I'm being real, Peak Games, the company that got acquired, made out like Robinhood on this deal. It seems like a great company with a cult following, but if I'm being real, I remember playing these types of games as a kid on an iPod Touch. And at least from a daily active user standpoint, Zynga has never been able to reach the level of success they saw nearly a decade ago with the massive boom in popularity of Farmville, and has remained relatively stagnant for the last 5 years. But just because user base is stagnant, by no means has revenue been, as microtransactions and the ever-changing digital ad landscape continues to benefit companies like Zynga. Like we started to talk about, the company has taken the approach of acquiring other people's hit games rather than developing its own, which, from their perspective, making games is a risky and time-consuming venture. Why not just acquire other companies with hit games who have already been established? Which, I guess, has been working out for the company. As we can see from its balance sheet, it looks like as of 2019, the company was finally able to start reaping in the rewards, with a 125% increase in cash and short-term investments in 2019. And I'll spare you guys, but quickly, the company's cash ratio is 1.76, meaning its ability to pay off short-term debt with highly liquid assets is strong. In their earnings call, they also state that they were able to increase its monthly revenue by $36 million without incurring more debt, which is great. And with the amount of people with spare time during the pandemic, the company is expecting an even better fiscal 2020. I should also note, Zynga has partnered with another quick stock company choice, Amazon, giving Prime members free mobile game content such as mystery boxes and exclusive titles, styles within their games. Anyways, let's wrap this up. With all of this in mind, what's our move? Well, I will certainly be holding on to my single share of Zynga for a lifetime. But to be blunt, I really have no interest in increasing our investment in Zynga, as we already have an investment in another quick stock company choice, Tencent, the world's largest video game creator, which is an absolutely boss company. However, I am certainly not hating on anyone who would want to start a position. After all, it is a solid company, and from a brand and financial standpoint, it should see an excellent fiscal 2020. And I can certainly see why many investors are hyping the company up. It's just, I think there's a better bang for my buck out there. And it's no hate towards the company, it's not a good fit for our portfolio. Anyways, guys, that's all we've got for today. As always, the best investment you can make is to go long on quick stocks. Hit that subscribe button now at 550 subscribers and plan an early retirement. I will catch you guys in the next one.